Today, we're going to talk about a part of the stock market that many investors tend to overlook, but that historically has produced some of the most impressive investment returns over time: small cap stocks. When people talk about the stock market today, most of the attention goes to the largest companies in the world. Names like Apple, Microsoft, Nvidia, Amazon, or Tesla dominate headlines and attract most of the capital flowing into markets. These companies are massive, global, and extremely influential. But if we look at history, many of these giants were once small companies that few investors paid attention to. At one point, companies like Amazon, Nvidia, or Tesla were considered risky growth stocks with relatively small market capitalizations. Small cap companies are typically defined as businesses with market capitalizations roughly between $300 million and $2 billion. They are often younger companies or businesses that operate in specific niches that are still expanding. Because they are smaller, they can grow much faster than large corporations. A company worth $1 billion can double its size much more easily than a company already worth $1 trillion. However, this potential for growth comes with additional volatility. Small cap stocks can experience bigger price swings, and their businesses may be more sensitive to economic conditions. That is why small cap investing requires patience, diversification, and a long-term perspective. But for investors who are willing to do their research and focus on strong businesses, small cap stocks can offer very interesting opportunities. Today, we are going to look at 5 small cap companies that many investors believe have strong long-term potential. These companies operate in different sectors of the economy, from technology to consumer products to infrastructure. The goal is not to suggest that these are guaranteed winners, because no investment ever comes with guarantees. Instead, the goal is to explore businesses that are operating in growing industries and that could potentially benefit from long-term economic trends. Before we begin, if you enjoy calm and thoughtful discussions about markets, investing, and long-term financial strategy, consider subscribing to the channel. It helps support the content and allows this channel to continue producing educational videos like this. Now let's start with the first company. The first small cap stock worth discussing is Celsius Holdings. Celsius operates in the rapidly growing energy drink and functional beverage market. Unlike traditional energy drinks, the company positions its products as healthier alternatives focused on fitness, wellness, and active lifestyles. Over the last decade, consumer preferences have been shifting significantly. More people are becoming conscious of ingredients, sugar content, and nutritional value. This shift has created opportunities for companies that offer products positioned as healthier alternatives. Celsius has capitalized on this trend by building a brand that connects strongly with fitness communities and younger consumers. The company has also benefited from strong distribution partnerships that have allowed its products to expand rapidly across major retailers. In addition to growth in the United States, the company has been gradually expanding into international markets. The global energy drink market is enormous, worth tens of billions of dollars annually. Even capturing a small share of that market can generate significant revenue growth for a smaller company. For investors, the key question is whether Celsius can continue expanding its distribution network and maintaining its brand momentum. If the company continues executing well, it could remain an interesting player in the consumer beverage sector. Now let's move to the second small cap company. The second stock worth looking at is Upstart Holdings. Upstart operates in the financial technology sector, commonly known as fintech. The company's core idea is to improve the way lenders evaluate credit risk. Traditional credit scoring systems rely heavily on a limited set of variables, such as credit history and payment records. While these systems have been used for decades, many analysts believe they are outdated and fail to capture the full picture of a borrower's financial behavior. Upstart uses artificial intelligence and machine learning to analyze a much larger number of variables when evaluating loan applications. The goal is to create more accurate risk assessments and allow lenders to approve loans for borrowers who may have been rejected under traditional models. This approach has the potential to expand access to credit while also helping lenders reduce default risk. However, fintech companies can experience periods of strong growth followed by periods of volatility, especially when interest rates rise or lending activity slows down. For this reason, Upstart has seen significant fluctuations in its stock price over time. Still, the broader trend toward using data and artificial intelligence in financial services is likely to continue growing over the coming decades. If AI-driven lending models become more widely adopted, companies like Upstart could play an important role in that transformation. Now let's look at the third company. The third small cap company on our list is Crocs. Many people think of Crocs simply as a shoe brand known for its distinctive design. However, the company has quietly become a strong global business with impressive financial performance. Over the past several years, Crocs has significantly expanded its product lines and strengthened its brand identity. The company has also benefited from strong demand across multiple international markets. What makes Crocs particularly interesting is its ability to combine a recognizable brand with efficient manufacturing and strong profit margins. In addition, the company has expanded through acquisitions, allowing it to reach new consumer segments and diversify its product portfolio. Sometimes the most successful investments come from companies that dominate a niche category but still have room to expand globally. Crocs may not be a traditional technology growth story, but its brand strength and operational efficiency have made it an interesting case in the consumer sector. Now let's move to the fourth company. The fourth small-cap stock worth watching is Samsara. Samsara operates in the industrial Internet of Things sector, often referred to as industrial IoT. The company's technology platform allows businesses to connect physical equipment, vehicles, and infrastructure to cloud-based monitoring systems. Through sensors and software, companies can track the performance of their fleets, machinery, and operations in real time. This type of technology can help businesses improve efficiency, reduce costs, and optimize logistics. As industries continue adopting digital tools to improve productivity, the demand for connected infrastructure solutions is expected to grow significantly. Many sectors of the economy, including transportation, construction, and manufacturing, are only beginning their digital transformation. Companies like Samsara are positioned to benefit from this trend as businesses increasingly rely on data and real-time monitoring to manage operations. Now, let's discuss the fifth company. The fifth small-cap stock on our list is Axon Enterprise. Axon develops technology products for law enforcement and public safety agencies. The company is well known for products such as body cameras used by police departments. However, the company's long-term strategy goes beyond hardware. Axon has been building a software ecosystem that allows agencies to store, manage, and analyze digital evidence. This platform approach creates recurring revenue streams through subscription services. Software-based revenue tends to be more predictable and scalable than hardware sales alone. As governments and law enforcement agencies continue modernizing their technology infrastructure, companies like Axon may benefit from sustained demand. In addition, public safety technology has become an increasingly important area of investment as cities and governments seek to improve transparency and operational efficiency. Now that we have looked at these 5 companies, it's important to discuss the broader risks and opportunities associated with small-cap investing. Small-cap stocks often offer higher growth potential, but they also carry higher risk compared to large established companies. Smaller businesses typically have fewer financial resources, less diversified revenue streams, and greater sensitivity to economic changes. During periods of economic slowdown or financial stress, small-cap stocks can experience sharper declines. That is why investors should always approach small-cap investing with diversification and a long-term mindset. Instead of concentrating too much capital in a single company, many investors spread their exposure across multiple small-cap opportunities. Another important factor to consider is time horizon. Small-cap investments often require patience. Companies may take years to fully realize their growth potential. Short-term volatility is common, and investors who react emotionally to market swings may find it difficult to stay invested. However, for investors who focus on strong businesses with solid growth prospects, small-cap stocks can sometimes produce impressive long-term returns. When we look back at market history, many of today's largest companies began their journey as small-cap stocks that gradually expanded over time. Identifying those companies early is not easy, but it is one of the reasons many investors continue to explore the small-cap segment of the market. Thank you for watching, and see you in the next video.